So from that conversation, can you take it that for the better NABERS rated buildings, that in the Australian market, you're seeing an increase in rent and value, and or vice versa? And if so, do you think that that will translate into the UK market as well?
I think 100%. So that is something that we have seen in Australia for a long time, and maybe to start with that, there are lots of organizations that have access to financial data, high quality financial data from property companies, and because NABERS' data in Australia is public and most of it is on our website, it's very easy for organizations to match that financial data with energy performance, emissions, and NABERS star ratings. And because of that, there's been not one study, there's been like 5 or 6 this year alone. So they often release this on an annual basis. And I can give you a few statistics, but before I do that, keep in mind that every study has slightly different statistics on the exact percentage of which a high NABERS rating impacts your financials positively. It's a bit different in all the studies, but all of them have exactly the same trends. So the conclusions are the same for all of them. In short, a high NABERS rating has a positive impact on pretty much all the major financials in offices. To give you a couple, buildings that have a 4.5 star NABERS rating and higher, so the higher end of the scale, they have significantly longer leases. And by that, I mean like 20% longer. Part of the reason why that's happening, and obviously, as you know, longer leases is really important. It's a really key metric of the financial health and how much risk you have as an office portfolio. Part of the reason why that is happening is because a lot of really big players that rent buildings for longer actually are asking for high NABERS ratings. So if you have a higher NABERS rating, chances are that you might have a bank in your building, or you may have attracted a government a tenant since. So that is having an impact on the length of leases, and it's quite substantial. The second one is vacancies. So it's not just like the price at which you are renting that office space, but vacancies is actually very marked difference. And buildings that have a high NABERS rating have basically half the vacancies than the rest of the market. And as you know, vacancies are, again, a really big indicator for office portfolios, because if you have vacant space, you're actually leaving a lot of money at the table. And so vacancies, I think the average in Australia at this point obviously changes over time. And for buildings with low NABERS ratings, it's about 8%. Buildings with high NABERS ratings have a vacancy of about 4%, so about half of that. And obviously that is very, very strong and important for the financials of property companies. Some of the larger owners, which we often meet in Australia, that have seen this effect very clearly in them. The basic is that the value of that decrease in vacancies from 8% to 4% for them, if you're in a big portfolio, can be worth literally like tens, or even like cutting like the $100 a year mark in terms of additional revenue. So we're not talking about like small financial impacts. It's very, very strong financial incentives for buildings to get into that higher energy efficiency zone, because there are some really concrete benefits to gain. And this goes into other financial indicators, but maybe like the one that kind of summarizes and aggregates all of them is value. As in, if you're going to sell the asset to the market, all else equal, same, premium versus premium, or A grade versus A grade, in the same kind of part of the city, what is the impact of the NABERS rating? There's also really good data about that. There's a really clear impact. The percentage that impacts on the value of your asset changes from study to study. So some of them go as low as like maybe 4 or 5% if you have a high NABERS rating. Others go all the way to like maybe like 15% or even higher. So it depends a little bit on how you cut the data. But I think the overall summary is that every study that we've seen has shown a very clear impact on the sell price for that asset once you go to the market, if you sell it. And again, that is kind of aggregating the fact that that building gets better rents and is likely to have less vacancies, and it's likely to have longer leases. And so all those things do translate to a lot more value in the market. Now, that 4 or 5% is the low end estimate. It can go a lot higher, but let's just reflect for a minute what that means. Because if you have a medium rise or high rise office building in Australia, that building is probably worth, depends on where it is, but anywhere between $200 to $300 million. If you can get a premium of 5% when you sell that asset, you're talking about like a return of like an extra 10 or $15 million when that building is sold. And sorry, no, and when that building is sold, and that is actually significantly more money than what is needed to bring that building from maybe 2 stars to 5 stars. So the fact that we've seen that return every quarter for 10 years in a row has been very marked and very well known in Australia, means that that becomes a driver on its own. So we've seen lots of owners that want to sell an asset in a year, 2, 3 years, realizing, well, if we invest in energy efficiency now, we actually will see really concrete and much better return when we sell that. The return on investment on that is very big because you don't need that much money to get to 5 stars. So we've seen a lot of market dynamics that are really interesting, and that is becoming a driver for sustainability on its own.